Okay, I think we're going to get started. We'll start with a roll call.
Councilmember Kelly.
Recording in progress.
Committee Member McMillan.
Here.
Committee Member Livingston.
Here.
Chair Rikus.
Here.
All right, so we do not yet have a quorum, so we cannot vote on anything, but we're going to proceed with some of our non-voting items, namely the education session after public comment, and hopefully we'll get a fifth member
Yeah,
here
we're trying to get
have
the
a
quorum, so.
They are.
Public comment?
We'll start with people in the room in a sec, and then I think there might be one online that we'll get to. All right, let's actually start online, Mary, if you're ready. Yeah, and then we'll come back into the room. Yep. Mary Rosinski, are you able to unmute?
Hi, thank you so much. I appreciate that. I just had two questions, and one related to the meeting when you were talking about the $500,000 as a limit. And I'm so puzzled by why we would go over budget $500,000 on projects and how many of those would be limited to. So I'm just trying to understand that logic. And the other thing I was wondering, when I looked at the bills paid yesterday on the city council, there was one that was invoice for paid from 2023 bonds, and I didn't think that we had issued any bonds. So those are just the two questions I had. Thank you so much.
Thank you. No worries, no worries.
Good evening. My name is Jack Mortel, 70-year resident of Evanston, retired Evanston Fire Captain and President of Evanston Firefighters Pension Fund. With budget season getting into full swing soon, I want to provide some further transparency of the final 2023 budget numbers as presented by staff to this committee and City Council. I printed off all the funds. According to the staff's documents, I broke out this and I put it just what was like this. We were 105.6 million over budgeted. Expenses were over budgeted by $105.6 million. Now there's a flip side of that coin, because where was that money going to come from to pay for those? So I'm thinking, oh man, we might have had a windfall here. We took in all this revenue and we didn't spend it. Well, apparently that's not the case. They also did a nice job, and I appreciate getting this. I was able to go through there and redline. There's a line in here called other revenue. I'm not sure what other revenue is, but it's other revenue. Well, it's a big number. It's a really big number. It was 105.6 million, 97 million in other revenue. If you add up all these other revenue lines throughout this document, it is 97 million. However, the actual other revenue collected in 2023 was only about 16 million. So it's about an $81 million difference that was going to balance the budget that never came in. There was also another one, it should be noted. It's called intergovernmental revenue. That's not in quite as many of these, but it's through a lot of these budgets to balance these funds. And that was for $17.7 million, if you add all those up. Now, actually, 10.7 did come in, but that's another 7 that didn't. So we're 87, 88 million of revenue that was going to balance this bloated budget that never came in or went back someplace. Or it's an awful lot of money, and we've missed the mark by quite a bit. And the one sheet I was looking for is I took the recent audit, and I looked at the numbers for excess revenue, those type of things. We shed a load I think it's 32 million. We shed 32 million off of that unassigned funds. That's a giant amount. Now, I know some of that went to pension, which would have been around 4.4 million, and some went to those unbudgeted transfers. That was around 8 million. So you're at 12 million. We're still, I'd like to know where that other 20 million of unassigned funds got shed in 1 year. 1 year it got spent. Poof, it's gone. It was in, and that's the difference between the 2022 budget and the 2023 budget. So that's it. Thanks for your time. I apologize for being disorganized.
Thank you. Any other public comment? Okay. Okay, we are going to skip over the minutes and go to P1, presentation. And I know Clayton and Hadesh worked very hard on this, and I went through it with them, and I think it's going to be really beneficial for us all as we get into the audit.
Thank you, Chair, and the members of the committee. Obviously, Clayton has worked hard on this one, and so he would go through that. I just want to tell you that, okay, I mean, we have the Martha Turtle from Sikich, which are our auditors. So, and we kept the items second so that some of those terminology, she can directly answer as the auditor, you know, whether unrestricted fund balance, unreserved, reserved, non-spendable, a lot of things, you know, type of funds, what's the purpose. So I thought that it might be better instead of the staff responding to that, you know. I mean, we are there, but yeah, Martha, she says, yeah, I'll be happy, you know, spend first 30 minutes for that and then the audit presentation, you know. So I'll, yeah, hand it over to Clayton for the presentation.
Thanks, Tash, and thank you, Chair Rikus. I think this is a great idea and hopefully can clarify some of the topics and conversations we've had over the past year. Just to give sort of an educational session on a handful of topics. So important to note that I'm not an accountant. I'm not a CPA. I'm not the accounting manager. I don't, this whole book, I probably only understand a portion of it that I need to as it relates to doing my job effectively as budget manager. So I know it, and I think I know it enough to be able to share it and present to this committee. But I just wanted to give that context that we're joined by, as Hitesh said, Martha Trotter with Sikich. So any super deep questions about accounting practices, I'm probably not the person to answer, but I think I know enough to talk through this, and certainly if you have questions, I'm happy to entertain them or let Martha answer. So this, here's a list of the things that I plan to talk through this evening. First, the types of funds that the city uses. Just important to note why we use fund accounting in the city of Evanston and why all communities use fund accounting. We talk a lot about fund balances and cash balances. I want to show how you can calculate that. Looking at the audit report, give you a couple examples of how that gets calculated and how it varies among the different types of funds. Talk a little bit about our audit process, and then talk a bit about fund equity terminology. So non-spendable, restricted, unrestricted, committed, assigned, unassigned, all words that get thrown out quite a bit, sometimes interchangeably. They all mean very different things. So I want to differentiate what those topics, what those words mean, and how, and use some examples from some actual fund balances to show the assigned fund balance, the unassigned fund balance, and some of those other topics that we've heard about. Then finally, talk a little bit about reserves and excess reserves and how to calculate that, both as part of the audit and throughout the year using our monthly reports. So first, the different types of funds. I'm going to read something directly from the transmittal letter of the audit, as it does a pretty nice job of summarizing fund accounting using just a couple sentences. So the city uses funds to report on its financial position and results of operations. Fund accounting is designed to demonstrate legal compliance and to aid in financial management by segregating transactions related to certain city functions or activities. Each fund is a separate, self-balancing accounting entity. So important to note, while this report takes a bunch of funds in a lot of places and kind of combines it into an overall statement of revenues and expenses and statement of position, using fund accounting, they're all treated differently. There's different restrictions in place depending on the fund. And so I hope to walk through a few of those restrictions, where there's flexibility and where there's not. First, these are all the governmental funds. So general library, special revenue, debt service, TIF, SSA, and capital. These are the governmental funds. General funds, and in parentheses is the number of those funds that we have at the city. So first, general, most flexibility, includes a general fund and the human services fund, basically the city's money to use with very, very few restrictions. Library funds, 3 funds controlled by the Evanston Public Library Board, 1 for operations, 1 for capital, and 1 for debt service. Important to note that the library doesn't actually have a dedicated capital revenue source either. Their primary revenue is property taxes, and it's used for operational, capital, and debt service needs. We have special revenue funds. These track specific revenues and or specific purposes. For federal, so things like ARPA, CDBG, CDBG loan. State, things like MFT and E911. Those federal and state special purpose funds are very restricted. The federal government and the state says how we can and can't spend those funds, so we have to track those very carefully. Where there is flexibility within the special revenue funds are those that we've set aside for a special purpose. So things like sustainability, reparations, affordable housing, these are all self-imposed restrictions. And again, if we wanted to use those funds some other way, we have that flexibility. Debt service, we have 1 fund. This is for servicing of general long-term debt. TIF and SSA funds promote economic development, capital investment through property tax increment and new development, special tax assessments. And then you have capital funds, which is for the acquisition, construction of capital assets. They finance the cost of major infrastructure projects, roads, parks, facilities. So these are all the governmental funds. Then you have enterprise or proprietary funds. These are supported by user fees and budgeted on a full accrual basis where expenses are recognized whenever a commitment is made. You have the internal service funds. This is equipment, fleet, and insurance. Again, there's flexibility in these funds because we're taking money from other city funds and transferring it to these funds for a general operation across the city that multiple departments share. So we have equipment replacement, has contributions from water and from general fund and library fund, fleet, and insurance. So those are funds that get money from other funds in order to sustain themselves. And then finally, you have the pension funds. We know a lot about those, obviously held in trust by the city, but controlled by separate pension boards. So that's the different types of funds. And when talking about funds, we often talk a lot about fund balances and cash balances. Throughout the year, we report changes to fund and cash balances as simple revenues, net expenses. As part of the audit, we make many one-time, once-a-year adjustments to come up with these numbers. These are always going to be the very best, most accurate fund balances and cash balances you'll find because we make those once-a-year adjustments for a variety of things that we'll talk about both throughout this presentation and that Martha will cover later on as well. I tweaked the formatting ever so slightly, but the content should be exactly the same. Just made it a little fancier to look a little cleaner. So fund balance for our governmental funds is assets, less liabilities, less revenues that are available in future years. So assets includes cash and investments, accounts receivable, advances, liabilities, fairly straightforward, accounts payable, unearned revenue, amounts that are due to other funds as well as any advances, and revenues available in future years. So as an example, there's a new GASB 87 requirement that required us project the amount available from leases in future years. And so we net that as part of calculating the fund balance because that's not revenue this year, it's revenue that's available in future years. So we have to net that out to come up with our fund balance. And as I said, throughout the year, when you see fund balances in our monthly report, it's generally a factor of revenues, net expenses, comes up with, compared to last year's fund balance, gives you the current projected fund balance. But there's a lot of things here that we adjust once a year. Things like those lease adjustments I talked about, some of our amounts receivable, some of our amounts payable, those are all reconciled at year end as part of this, assigned to the proper fiscal year. So sometimes we receive money in January that's actually money for the previous fiscal year. It's not cash at the end of the year, but we have to reconcile that, and that all gets done as part of this report. And this is for the governmental funds. This gets quite a bit more complicated when you talk about our enterprise and internal service funds. For this, it's a calculation of current assets plus non-current assets, plus deferred outflow of resources, net current liabilities, non-current liabilities, deferred inflow of resources, and net investment in capital assets. Fund balances for enterprise and internal service funds, certainly more complicated. And at year end, all of the non-current assets, the non-current liabilities, and the deferred inflow and outflow and net investment of capital, which is 5 of the 7 things listed on the board. 5 of those 7 things are really reconciled and calculated at year end as part of this audit process. And so we adjust for capital assets, we adjust for depreciation. Non-current liabilities includes loans and bonds that are going to become payable in future years. Claims payable in our insurance fund, we have an idea of how many outstanding claims we have and how much that's going to be when it comes due. But again, we reconcile that at year end. And then calculating the cash balance, quite a bit simpler. It's cash and equivalents plus investments, plus or minus the amount due to and from other funds, plus and minus the advances to and from other funds. So you can see we remove all of the non-liquid variables from the calculations. Pretty straightforward calculation of cash, equivalents, and investments, and due to, due from. So kind of a quick synopsis of how we calculate fund and cash balance. And again, like I said, so much work is done as part of this report that Martha will go through in greater detail. This is a list of some of the adjustments that are once a year adjustments, which is why this report's so powerful, because we know it's accurate, good, strong fund balances that takes into consideration all of this. So once a year, we figure depreciation and make other adjustments to capital assets. We reconcile year-end amounts payable and receivable. We reconcile any prepayments. So sometimes we pay up front for a fire truck to be built and we don't actually have the fire truck, and so we have to reconcile how that gets accounted for. Enterprise, geo bond, and loan principal and interest, adjustments for loans and leases, identification of deferred inflow and outflow of future resources, identification of any inventory sitting on hand in our public works, fleet department, and other water department at year end, and ensuring that capital expenses and retainage are assigned to the year that work is performed. So we can't just carry forward that retainage if the work was performed in the previous year. It has to be accounted for as part of this report as well. So I say all that just to really push the point home that putting this report together each year is a all hands on deck process. This ran by our finance department and takes a lot of work to put together, which is why we're here in June talking about year-end finances for last year. So with that.
Oh, question?
Yes.
Can I just add one quick question? Would it be fair to describe that during the year, most funds are primarily on a cash basis, and then at the end of the year, the balance sheet accounts are trued up to full accrual basis?
Thank you.
That
Yeah,
is
I think
primarily
that's
what's going on.
Very good way to put it. Yep.
Right.
I guess with cash basis, it's revenue, net expenses throughout the year is sort of how we look at fund balance and consider it.
Right. Income, everything's expense, but then what could be capitalized, part of your audit process is the balance sheet accounts are trued up as part of the audit process.
Yep.
Did you have a question?
Not part of my presentation, really, not a topic I'm going into detail
Okay.
on. They're not in our.
Yeah, I mean, and again, I would enter it. I don't know how we want to handle the public comments. We can answer, if they get a question. But just, yeah, the pension funds are held by the state right now. We just have to report them in our fiduciary capacity. So we report them under the fiduciary funds.
Oh, we're not holding them.
Right. We don't have
Okay.
any money with us.
Okay, thank you.
All right, so that's fund and cash balance in a nutshell from a non-accountant and sort of how a budget person goes into it and considers that. So with that in mind, now that you know fund balances and cash balances, once you have that fund balance, GASB 54 provides guidance on how you break down that fund balance into different categories. They define 5 categories: non-spendable, restricted, committed, assigned, and unassigned. Committed, assigned, and unassigned are all considered unrestricted. Unrestricted includes all those 3. But just walking through them, non-spendable fund balance are amounts that can't be spent because they're not in a spendable form or there's legal restraints against spending them. Restricted is when constraints are placed on their use by either external groups, creditors, grants, laws, TIFs, SSAs, MFTs, CDBG. When you look in the audit report, all of those fund balances, the entire fund balance shows as restricted because of how those funds are set up. Then you get to unrestricted, and these are more local restrictions. They're unrestricted because there's no external body that's sort of restricting how you can and can't use them. But we've put some of our own rules in place on how that can be spent. At the next level of restriction is committed. This is where constraints have been placed on their use through formal action by the city. So sustainability, reparations, affordable housing. The city's taken formal action to say, well, these funds are for this special purpose. And so in the audit report, you'll see that those funds show as committed. Assigned, so this is spendable fund balances intended for specific purposes, but not considered restricted or committed. So committed and assigned kind of, from my point of view, they kind of appear the same way and kind of considered assigned. So in the Crown Construction and Maintenance Funds, that's donations from Friends of Crown that the city is committed to covering and offsetting the debt service on that building.
Clayton, why are they under the unrestricted category? Because they sound like they're kind of restricted in the way we can spend them.
I'm going to answer it, and then if I answer it incorrectly, I'll invite our auditor to correct me. I consider restricted based on restricted by external forces. So forces like the federal or state government says these are restricted versus us, the city of Evanston, saying they're restricted. Is that a fair point? Okay. And then you get to unassigned. So this is the residual positive and negative fund balances that have not been classified. The biggest fund balance deficit we have in the city is in our CIP fund. At the end of last year, it was negative $8 million. That's considered an unassigned negative fund balance. The unassigned fund balance includes both reserves and excess reserves. So when you look at that number and it says it's unassigned, yes, it's unassigned, but technically part of that unassigned amount is the reserve, the 16.6 in the general fund, the 25% in MFT, 16.6% in water. Those are all considered unassigned, even though they're part of our reserve. And I'll get into more detail on reserves and excess reserves later. Just wanted to clarify that when it says unassigned, that does include both reserves and any excess as well. So just a couple examples on calculating fund balance and cash balance. This is a fairly simple, straightforward example. The E911 fund, heavily regulated by the state. They tell us how we can and can't spend this money. You can see the entire fund balance of $1.6 million is considered restricted in the audit report whenever you look at that calculation. From a fund balance perspective, you can see it finished last year at $1.6 million. Cash finished at $1.2 million. The difference is largely this $361,000 that shows up as part of fund balance, but not part of cash balance. So what that is we get money for October, November, and December in January, February, and March. So at year end, that's not liquid cash. It doesn't show up on the cash side of the ledger. It shows up on the fund balance because it's not liquid form at the end of the year. Additionally, we have $24,000 in vouchers payable. So this is simply the last bills list of 2023 had $24,000 on it that was for expenses incurred in 2023, but we didn't pay those invoices until calendar year 2024. So they show up as a payable as part of the audit report, but they still are reflected in the fund balance, but not the cash balance because the cash is still shown in the bank. Taking a more complicated look at the general fund. In this case, you can see the fund balance finished at $49 million. Cash finished at $47 million. And you can see a number of variables here considered on the fund balance side, but not considered on the cash balance side. Some of the big things that are included in fund balance include property taxes, which are collected in the following year against the previous fiscal year. So those show up as part of the fund balance, but not on the cash side because, again, not in liquid form at the end of the year. Amounts due from other governments, as we've talked about before, we get our sales taxes 3 months in the rear, our home rule sales taxes 3 months in the rear. So again, those show up as a due from, but not part of the cash balance. Again, we have the accrued payroll. We accrued the payroll. The last payroll of the year shows up here as in this number. And we have vouchers payable. So this is, again, that last bills list of the year for services incurred in 2023, but not expensed in 2023. So they show up in the fund balance, but not the cash balance. Also important to note that the general fund is complicated when you look at our audit because it includes both the Human Services Fund and the Foreign Fire Fund. And I know Martha's going to go into some detail on that, so I don't want to muddy the waters and try to explain that on my end. But when you look at this $49 million fund balance, $4.4 million is considered non-spendable. Most of this is an advance from the general fund to the CIP fund. The CIP fund, as I mentioned, ran low on cash in the absence of bonds last year, so we've done an advance from the general fund to the CIP fund. It's a temporary measure in order to keep those projects moving forward, so it shows up as non-spendable. We have $10.5 million that shows up as assigned to the FY 2024 budgeted deficit. This was something that was not reflected in last year's audit, and again, I'll let Martha go into more detail on that, but that's considered an assigned amount. We have $2.4 million that's considered assigned. It is for items found on document page 59 of the audit. It lists those $2.3 million in programs that have that fund balance assigned to it. And that leaves an unassigned fund balance of $31.8 million. So that unassigned fund balance of $31.8 includes both reserves and excess reserves.
And you're going to define both of those a little later?
Yes, I will, as part of the next component.
And Councilman Kelly, did you have a question because your light's on?
Yeah, it was back a ways when we were talking about pensions, but I'll hold off.
Another example, the CIP fund. This is the second largest variance between fund and cash balance. The largest variance is in the ARPA fund, where we have a really large variance between our fund and cash balance. But in the CIP fund, you can see we finished with a fund balance deficit of $8.1 million and a cash balance of $3.5 million. This is largely due to this vouchers payable. This is mostly IDOT expenses that we could be billed for tomorrow, we could be billed for next month. We've been waiting a long, long time for these invoices. It's not all that. Part of this is, again, that last bills list of the year, as well as any outstanding invoices that had not been received by the end of the year. So again, a big number, and part of this is tied to a TIF expense as well that's booked in the CIP fund. So that's the reason for this big variance. And then unearned revenue is related to a long-term easement recognized over time. So long story short, 4 of these 6 things are included in the fund balance calculation. These 2 things that are not considered liquid, not considered in the cash balance calculation. Still waiting on those invoices, and this revenue can't be counted in 2023.
We have a question.
So now that you've done your bond issue, I think what went in CIP was maybe 15 million. So you would have repaid the general fund. The cash would go in, so you would have corrected this deficit, I guess.
Yes, you're
Yeah.
right. We are going to get the money on Thursday.
Okay.
So yes, we will give all the money back to the general fund.
So just to be clear, so that was money taken to, because payments were made, and so the money was taken from reserves.
General
So,
fund.
right, so that money, when it's reimbursed, will go back into the reserves, correct?
General fund, yeah.
The
Went
general
back to
fund
general
reserves.
yes.
Okay.
I mean, it's a fund balance. That's the one thing, including reserves or whatever. But it was taken out of general fund and transferred
Reserves.
to CIP.
But it was
fund.
taken from the reserves to cover those costs, right?
We just take it out of the pocket. We don't have 2 separate things for that. This is just for our internal purpose. What is 16.6% plus any excess? But when we transfer money from one fund to the other, we just take it out of the total fund balance.
So what will you reimburse?
We will just give it back to the general fund, and general fund balance would, and when we report the general fund, even cash, we include that number because that cash technically belongs to general fund. It is just advance on a temporary basis. So you won't see any change in the general fund overall cash number because right now we already include that $4 million.
Yeah.
Is that in the due from governments?
Yeah.
Or-
No, not
Advances
from-
to other funds. I
Advances
think if you
to
look
other
at the
funds.
prior page in the general fund, it shows in the fund balance, 4.3 million.
Yeah, advance from
Of-
other funds.
That's
Yeah,
the
you were right
receivable
there.
from the CIP fund. There's a
to second, yeah.
liability in the, offsetting liability in the
Right.
CIP fund, and now it's just the
So that advance would
Money's
go
been put
away.
back. The
and
cash
the
is now
cash would
higher.
move back to the general fund.
cash move back to.
And then just one last example from the water fund. You can see the much more complicated calculation here that considers current and non-current assets, current and non-current liabilities, and deferred inflow and outflow of resources. Some of this large number in non-current assets, this is depreciation and accumulated depreciation on capital projects. The non-current liabilities, this number includes GO bonds payable in future years, loans that are payable in future years, and then net investment in capital assets, essentially the value of capital assets that's non-spendable. It's just the value of our assets to come up with the fund balance and the cash balance as well. So that is sort of a look at the terminology and some examples on calculating fund and cash balance. Looking now at reserves, excess reserves, and fund balance policies. So once you have a handle on sort of breaking down your fund into the different levels of fund equity, looking at that unassigned fund balance and determining how much of that is the reserve and how much of that is considered excess reserves. So 15 of the city's 40 funds have reserve fund and cash balance policies in place. They're all found in our budget document on pages 36 through 40. You can see for our 4 enterprise funds in our general fund, that policy says 16.66% of annual operating expenses are considered the reserve. MFT and capital is 25%. Fleet and equipment replacement have somewhat strange policies that basically just say that you have to keep positive cash. The insurance fund has no less than 3 months of actual expenses held in reserve. That's about, I believe, 3.5 million is what 3 months of annual expenses are, in cash at 25% of outstandable claims payable. And then the TIFs are based on outstanding debt. It's kind of very vague as well. It doesn't say, X percent of outstanding debt. It's just said set your reserves accordingly based on the amount of outstanding debt that you have. I'm not going to go through this one. It's in your report for reference, kind of a good quick snapshot that you can use to know where we finished 2023 from a fund and cash balance perspective. I am going to look at this report. It is in your packet. Hopefully you can look at it there instead of on this screen, since the numbers are a bit small. But these are the 15 funds that have those fund balance policies. In this column, and these 4 columns break it down by fund equity. So you can see the amount that's considered non-spendable, restricted, assigned, and unassigned. So again, you have the MFT fund and the TIF funds. The entire fund balance is considered restricted because, again, there's outside restrictions from the state, federal government put in place. I guess in this case, it's all state government that says how we can and can't spend those funds. So those entire balances are considered restricted. And then you see the unassigned fund balances in parking, sewer, solid waste, and water, and in the general fund here. So most of these are fairly self-explanatory. The general fund, I gave you that calculation earlier of what the unassigned fund balance is. It was that $31 million number. 3 months of operating expenses, or 16.6% of annual operating expenses, the same thing, 3 months. 2 months, thank you, sorry. 2 months of annual expenses, or 16.6% are the same thing. That cost is $24 million. So you just take the $31 million unassigned fund balance minus the $24 million, gives you the amount of excess reserves at the end of last year.
Clayton, just to repeat that, so we basically, the excess reserves are 7.9 now after we use some of the money for the budget and the assigned. When that money comes back from the bonds, is that going to increase that to 15 million, or what? How does that work?
In that case, when that 4.3 million comes back, that 4.3 million is shown as a non-spendable. And so that non-spendable amount would go down and the unassigned would essentially go up. Does that make sense?
A little more excess. 4.3 more.
Yep.
Okay.
And again, the assigned, this is where the big swing was this year. This is the 12.8 million. 10 million of that is the deficit that is assigned to this year's 2024 budget. And that's considered assigned per our auditors and is shown as such in our audit report. Now, if revenues come in better than expected, we have a really great year, and we'll provide a mid-year update next month to give you an idea of where we stand. Hopefully we don't need that full $10 million to be considered assigned, but per this report, that's how that gets classified and considered. The insurance fund was another big one I wanted to just briefly touch on. So again, the policy says that you have to have no less than 3 months of annual expenses held in reserve. It's referring to the cash balance. It finished with a cash balance of about 3.2 million. You can see 3 months of health insurance expenses is about 3.5 million. So it finished just slightly below its fund balance policy after many years of being $6, $7, $8 million below its cash balance policy. It's crept back now really close to that policy thanks to those measures taken last year.
And the measures taken last year was the transfer so that we were abiding by our policy.
Yes. We did a $1.9 million transfer to Fleet, and you can see it finished with $46,000 in cash. So you can assume that 46,000 minus 1.9 million would be where we would have finished without that money. And then insurance finished at 3.2. So it would have finished with just $200,000 in cash without that $3 million in support from the general fund.
I know you told me, but the $6 million of excess in the sewer fund, can you explain that?
Do you want to?
So yeah, I mean, the more details, I mean, we have, what do you call, I sent the email to Daryl King, who is the water and sewer project handling, and I don't know whether Lara has anything in the mind about the sewer project, but Paul Mayano, who is the other kind of handles this thing. So they might, yeah, we can share, you know, once the details are available. But the one thing is, and I think Martha can touch on that, how the enterprise funds unrestricted are calculated. There are two categories of fund balance major. One is called net investment, you know, investment in capital asset, net of debt. So sometime during the year, depending on how many capital assets we added versus how much we debt added or paid off, that would affect the unrestricted number, you know. Obviously, yeah, sewer fund is reporting around 1.9 million net income. So that's a good thing, you know. It's a, yeah, kind of operations running in surplus. So that's a good thing. But sometimes, yeah, the capital projects might take away some big amount. So we'll have to wait and share those details, you know, later in the month, yeah, as we get to the budget.
Can I just, and Hitesh, certain of these enterprise funds provide a recurring stream of profits back to the general fund, don't they? It's about $4 million a year or something.
I mean, it's the water fund, we do the transfers, you know. So yes, I mean, we might have some kind of a different amount. We might suggest some changes, particularly from water and parking fund, to better reflect the true enterprise fund operation.
Okay.
I think water's always $4 million a year,
Yeah.
right?
And there's
Plus.
some amount from parking fund too. So yeah, we'll, as a part of this 25 budget.
Yeah.
Hello, my name is Laura Biggs. I'm the city engineer. So when we talk about water fund balances and sewer fund balances, when people receive their utility bill, they're seeing a combined rate. And so generally speaking, we have many fewer obligations in the sewer fund. It's a smaller fund than in the water fund. But as we build up a cash balance, we're looking each year when we need to do a rate increase on water, we try to do a corresponding rate decrease in sewer. So if you see a cash balance starting to build up, most likely next time we're talking about rates, that's going to be eaten up as we just lower the sewer rate. Over the last 10 years, we have consistently been lowering the sewer rate each time we do to help offset any water rate increases because we have had extraordinarily high sewer rates for a while. We did a substantial sewer system improvement that cost $210 million and was accomplished over a 20-year period. That more or less wrapped up in 2010, but since then we've just been retiring debt. So the sewer fund never really gets to be an extraordinarily high balance because we're always using it to offset water rate increases.
Okay, very last slide, and then we'll move on to the audit report. So just the takeaways. Oftentimes we do hear things regarding numbers, very large numbers, be it from our quarterly cash update, the audit report, or the budget. They look at the top level, combining lots of numbers, lots of cash into a really large number. We've stressed it before, but each fund is a separate self-balancing accounting entity, different restrictions, requirements, policies, and procedures. So these reports that show the fund and cash balances by fund are really the best place to start to ask questions about the question about sewer reserves. A very fair question. 6.6 million annual expenses, don't really seem to justify that, and we can answer those types of questions and react accordingly. On a fund by fund level, I think it's easiest to have those conversations. And as well, we have flexibility within these numbers. As I said, there's some of these funds that are considered unassigned. It's our money to do what we see fit with, and so knowing how to figure the amount of unassigned fund balance is important because that's really where that flexibility resides. Talk a bit about fund equity. So again, 5 levels of fund equity set out by GASB 54, non-spendable, restricted, committed, assigned, and unassigned. And unassigned is the accounting term for them. While it says unassigned, a portion of that unassigned is considered assigned to that excess reserve in accordance with reserve policies. Again, significant adjustments. Second to last bullet point, throughout the year, changes as committee member Livingston mentioned on a cash basis really throughout the year where we report revenues, net expenses, compare it to last year's fund balance. but significant adjustments made that we just talked about as part of the audit process that we'll talk more about as part of the next agenda item. So.
Well, thank you very much, because this is very confusing with all the assigned, unassigned fund balances. But I think the key takeaway, and Member Livingston and I were talking, you know, the 49 sounds like a big number in our fund balance, but when you take out the general fund, but when we take out the assigned and the unassigned and the fund required, we're at 7.5 million, maybe another 4 million, that's 11 million. So as we head into budget process, we really need to sharpen our pencils so that we can get a budget that doesn't have a deficit. So that's really going to be kind of our goals.
Like, yeah, Jack Mortel.
Question, because I didn't, okay.
It showed, it's terrific. It showed 23 and 22. And the CIP, I took the revenue versus what they spent. And in 2022, they spent 9.6 million more than the revenue they took in. And then I did 23, what you handed out, that's 9 million. Maybe I'm adding them wrong or something. But the bond, when you floated it, it was to repay for 20, if I'm reading it right, the proceeds of the bonds will be used to reimburse the city for its prior expenditures on certain capital projects detailed in Resolution 4/2022 adopted by the City Council on January 10, 2022, and then also for one in 2023. So they're talking about going back 2 years with this reimbursement, not just that 4, whatever it is. I would certainly like to see an accounting of what, again, this is the official bond. It's to cover 2 years of.
So I think we talked about that time. We had the liquidity to defer bond issuance for 2 years, hoping rates would decline. They declined a little bit. Still not a perfect rate, but I think you did. That's a good rate relative to
which we're going to go over later.
Moment. We'll go over that. But it was an intentional 2-year deferral, go negative in the CIP because we had the overall liquidity to do it. But at some point, you need to issue the bonds. You need to
because the money had to come from somewhere, and how I'm reading this is has to be reimbursed.
Right. The general fund advanced the money until such time.
You got to reimburse what was spent from other funds, and that's not just 1 year. It says 2 years. It's really clear.
And I think that was intentional. Right, that was intentional to not issue bonds when we had the available liquidity, but eventually we got to the point where
if you'd like to read it, it says
no. We're not disagreeing. I think that, but it was
supposed to be
but it's what you're reimbursing, and I think this amorphous idea of it's just the general fund. I think it was taken from our unassigned funds, separate and apart from the reserve, which I understand are part of our as unassigned funds, so that it should go back into those unassigned funds, and therefore increasing our unassigned fund balance.
Can't help but respond on just a point, which I did talk about as part of the item, and then I'm going to hand it over for the next item. When you look at the CIP fund balance, this huge number of vouchers payable, this was cash in the account that was sitting in the account to pay IDOT when those $8 million in bills come due too. So a good portion of that is repaying funds that are assigned within the CIP fund to eventually be paid to IDOT when those invoices come due. So it was both the reserve in the CIP, we depleted the reserve in the CIP, we depleted the cash that we were holding to pay IDOT once those bills come due, and we started doing advances from other funds, 4.3 million last year, and even more so far in 2024 to keep paying those bills. So that's kind of the 4 sources of how we've paid those bills up until this bond issuance.
As far as the audit goes, we recorded this 2-year payback correctly. Well, thank you again, both of you. This was.
And I'll just introduce Martha Turtle. She has been the partner on our assignment with the City of Evanston from Sikich LLP, who have been auditing our firms. And yeah, I mean, we are on time. The report kind of was dated on June 27th. So yeah, I mean, I appreciate the work on the finance and our City of Evanston team, all of the department, but as well as the audits team, you know. So we kind of worked hand in hand and kind of, made sure that, we kind of delivered the audit report by the time we hit the June end. Okay, Martha.
So in terms of questions on what was just presented, are we waiting for all our questions until after the audit? I mean, I have questions about some of what was discussed. I don't know what tonight is. Are we all just?
Yeah, so, I mean, if you're thinking, like, if you can hold on to that, some of that might be question if you have the numbers related. So after that, Martha and I will take anything in general about the presentation as well as about the 23 numbers.
Okay.
Good evening. Thanks for, first of all, I think that presentation, ahead of me, is very helpful. Hopefully you found that very helpful. I think it's much more detail that I plan on going into with the numbers. My plan today is to present the results of the fiscal year 2023 audit. Our audit process spans through, essentially we begin our preliminary planning procedures at the beginning of the current year and complete audit testing procedures throughout the month of April in order to be able to issue the audit report on a timely basis as is required by Illinois compiled statutes within 6 months of fiscal year end. So as part of the audit process, we issue the annual comprehensive financial report. The reporting requirements associated with the TIF districts. The Illinois Comptroller's report is filed with the state, and there are communication to council members. There is a single audit component that is ongoing currently related to the grant-specific audit testing. So there's a significant number of reports that are issued as part of the audit process. What I'll be focusing on today is the annual comprehensive financial report. This is the 200+ page document that you have that was issued June 27th. It is a significant undertaking to prepare for the audit, to provide the adjusted trial balances to us. As was noted during the presentation, the city maintains monthly financials essentially on a cash basis. As part of preparation for the audit, the balance sheet accounts must be adjusted to modified accrual basis for the governmental funds and full accrual basis for the enterprise and internal service funds. So that's a lot of information that needs to be parsed through to ensure that liabilities, receivables, deferred outflows and inflows are all calculated and adjusted correctly in the financials, the trial balances that we receive for audit purposes. And associated with that, there's a significant amount of reconciliation work papers that occur at year end that are provided to us to audit and to complete our testing. Our testing is done in accordance with generally accepted auditing standards, and due to the level of grant activity the city has, we also perform our audit in accordance with generally accepted governmental auditing standards. So there's additional compliance testing that goes in addition to that. That is one of the reports that is issued within the annual comprehensive financial report. So I want to just note within the annual comprehensive financial report, there is we present the city's award of the Certificate of Achievement for Excellence in Financial Reporting. This is on page number 3 of the annual comprehensive financial report, is the certificate for the 2022 fiscal year audit. I just want to highlight this. This is a distinguished award to receive. This is issued by the Government Finance Officers Association, and what this lets you and the readers of the financial statements know is that the report is issued with a level of transparency and it meets the requirements of the GFOA. So all the information presented within the report goes above and beyond just GAAP reporting, but there's additional components in the financial statements that are required by GFOA to receive this honor. So we do include this as this was awarded for the 2022 fiscal year report, and the city has once again submitted the 2023 ACFR, which I am presenting to you, to the GFOA, and we do anticipate once again the city will receive that the GFOA certificate for 2023 report as well. Some of the components to meet the Certificate of Achievement program are above and beyond the basic financial statements, there is the preparation of the letter of transmittal that's included in the financial statements, which is prepared by the finance department. That serves to provide some context to the financial statements, as well as the statistical section, which is at the end of the report and provides up to 10 years of historical data related to different aspects of key operating indicators of the city. So 10 years of historical net positions, fund balances, changes in those balances can be found there. There's information on demographic and economic information. All of that statistical information is compiled as part of the audit process as well to be able to include in the issued report and to meet the requirements of the GFOA Certificate of Achievement Program. Pages 1 through 4 is where you'll find the independent auditor's report. So based on our audit procedures, which were, as I noted, conducted in accordance with generally accepted auditing standards and generally accepted governmental auditing standards, we were able to issue a clean, unmodified opinion on the city's financial statements. That's the highest level of assurance that we can provide. What that lets you know as the users and readers of the financial statements is that this information presented to you can be relied upon based on those in accordance with our audit testing and standards. Pages 5 through 6 of the financial statements is the report that's issued specifically related to the generally accepted governmental auditing standards. Had there been any material weaknesses or significant deficiencies noted as part of our testing, those would be required to be disclosed within this section, within this report. However, as is noted in these 2 pages, we noted no such instances of either non-compliance or any items that rose to the level of a material weakness or significant deficiency that would have to be reported here.
And is that unusual to have no deficiencies in your experience?
It varies significantly from entity to entity. The larger and more complex of an organization you have, oftentimes there's a lot more procedures in place, but there's also more opportunity for those procedures to fail if you have segregated departments and many entities reporting into one. So it speaks to the level of internal controls in place at the city that there were no items that came up. Procedures that we tested are being followed and in accordance with what is stated.
Can I ask a quick question? I'm just curious because you said how many people are involved in these audits?
So our team for the city's audit is four people typically.
4 people over what period of time?
Over the course, our testing, our detailed testing field work spans the month of April.
Okay, thank you.
Well, Member
How long has your firm been auditing the city?
I believe we've been auditing for the past 7 years.
Is it, similar with corporations? I know with the advent of Sarbanes-Oxley, you typically churn that every 5 years. Is that something that we do at the city level?
So, right. So for publicly held entities, there is a requirement for auditor rotation. For governmental entities, that's not a requirement that exists. We do have a significant number of partners or principals that are involved that are specialized in governmental audits. So some of our municipal clients do like to have a rotation of audit team, either the principal, the manager, or a full auditor team rotation. So over the course of the city's audit history, we have had some rotation of our audit team members as well as principal. So I have taken on the audit from previously Dan Berg was the partner.
Yeah. Let's say the public requirement is to rotate the partner, not the firm.
Not the firm.
Not the firm, yeah.
Following the GAGAS report is the management discussion and analysis. And I do want to highlight here, this is prepared also by the finance department, and If you read nothing else in the financial statements, I do recommend reading the MD&A. This is serves as an executive summary of the financial statements. It provides some context to the balances that are found in the basic financial statements and also provides some comparative data. So the basic financial statements only present the current year balances, whereas within the MD&A, you'll find a comparative current year and prior year balances and some analysis regarding the variances that were noted. So that runs from pages MD&A 1 through MD&A 8. Following that, I'll just highlight the statement of net position and statement of activities, which is located on pages 7 through 9 of the basic financial statements. So these are your first basic financial statements presented in the report. These are presented on the entity-wide level. So for all governmental funds in total are presented in the governmental activities column. The city's enterprise funds in total are presented in the business type activities column, and also the library component unit information is presented here as in the separate component unit column. So this information here, I'll just note that is presented on a full accrual basis of accounting and combined for the totality of those different reporting entities. With it being on a full accrual basis of accounting, what's included here that you typically don't see in your monthly reporting information is all the balances of your capital assets, net of any accumulated depreciation, all of the pension OPEB liability balances, so those related deferred outflows and inflows that are calculated by actuaries are presented here in these full accrual entity-wide financial statements. The statement of activities, which is on page 10, is where you'll find the change in net positions. So the net position for both governmental activities as well as for business type activities increased over the previous year's net position. So there was an improvement for both governmental activities and business type activities in total for a total increase in net position of $9.6 million for the city. Following the statement of activities, pages 11 through 14, and I apologize, the PDF is, it's a bit easier to read on the printed copies of the reports just because this spans 4 pages. But I just want to highlight, so here's where you'll find much of the detail of the balances that were discussed just prior to my audit presentation. Here is where you'll find a lot of that information. From an audit perspective, we present the basic financial statements for the major funds individually. So the city's governmental funds, which are considered major, are general fund, capital improvement fund, general obligation debt service fund, and the ARPA fund were calculated as major for 2023. So those are presented individually. And then there is a non-major column. So all the other remaining governmental funds are combined into one non-major aggregate remaining funds balances column. There is much more detail of those individual funds later on in the report in the combining and individual fund financial statements, but from our audit opinion perspective, we report our opinion on the non-major funds in total. So here is where you'll see on page 13 is the fund balances, so those categories that were discussed, the non-spendable, the restricted fund balances, which are restricted by external sources, and the assigned fund balances for general fund of just under 14.6 million, the unassigned fund balance for the general fund of 32.7 million at December 31st, 2023. That deficit fund balance for capital improvements is reported as unassigned because it is a deficit. Otherwise it would be, had it been a positive fund balance, that typically is presented as assigned or restricted for capital improvements. However, because of that deficit, it is reported as unassigned. So it reduces the total unassigned of the governmental funds total balances. But as was noted in the prior presentation as well, each fund has the reason funds are reported are based on certain restrictions as to what is funding those. So each fund is its own separate set of books, a self-balancing set of books, and is reported as such based on the type of activity that runs through and is reported in those funds. The statement of revenues, expenditures, and changes in fund balances for the governmental funds is on pages 16 through 17. So once again, for those non-major funds individually, and the total aggregate remaining funds is presented here. One thing to point out about these financial statements, the governmental fund information is presented on a modified accrual basis of accounting. So unlike what was discussed on the initial pages, this is modified accrual only takes into consideration liabilities or receivables that are expected to be received or received within the accounting policies of the city, where typical governmental revenues are accrued for if they're received 60 to 90 days within fiscal year end, and liabilities that are expected to be paid out within a year of fiscal year end. So those are more short-term in nature, not accounting for those long-term assets and liabilities. The proprietary fund financial statements are located on pages 19 through 23. Now, the proprietary fund statements are presented on a full accrual basis of accounting, so that total column listed here does equal to what the business type activities total column was in the basic financial statements, statement of activities and statement of net position. And then the governmental activities internal service funds column are those the fleet fund, the insurance fund. Those are at the entity-wide level presented as governmental activities, but they are accounted for as are the enterprise funds on a full accrual basis of accounting. So they're presented here along with the proprietary funds. And then lastly, in the basic financial statements, that pages 24 through 25 is where you'll find the fiduciary fund information. The fiduciary funds reported here are the pension trust funds, so both the police pension and fire pension trust fund balances are reported here combined. Within the footnotes to the financial statements, there's additional breakout of what makes up the police pension fund balance and the fire pension fund balances. So here in the basic financial statements, they're reported in total. However, the footnotes do break out what the individual police pension fund activity and fire pension fund activity had for the year. If you go to the next bookmark, here I just wanted to point out within the footnotes to the financial statements, there's a lot of information in footnote 1 regarding some of the definitions that were reviewed just prior to my presentation. So if you're looking for information on how items are accrued for, how items are accounted for by the city, what revenues are susceptible to accrual, for instance, certain governmental revenues, the city can accrue for up to 90 days post fiscal year. And so that kind of lines up with why our audit takes place in April, because that allows the city to collect all the revenues that are susceptible to be accrued. And so those receivables, rather than being estimated, are actual balances for intergovernmental revenues. But a lot of those descriptions and definitions of the accounting policies and procedures are defined here in the footnotes, in footnote 1 of the financial statements. So here, footnote 1.0 is the fund equity. That's the description of what is considered non-spendable, restricted, committed, assigned, and how that lines up in how it's presented in the financial statements. There's descriptions of what is considered a deferred outflow and inflow, as that's not a terminology that most people are used to hearing. So that description in footnote 1M is a description of what is a deferred outflow and what is a deferred inflow. Those are assets presented as assets and liabilities, but those relate to timing of when the underlying expenditure or revenue will be incurred. So a deferred outflow is presented as an asset, but the expenditure associated with it is not expected to be paid out until subsequent years. A deferred inflow is presented as a liability where the related revenue will not be collected until future years. So currently they're sitting on the balance sheet as an asset or a liability. There are underlying expenditures or outflows or inflows associated with those that will come in or be paid out in future years. That covers the basic financial statements. Like I said, there's a significant amount of detail following the footnotes. The detailed budget versus actual schedules for all of the budgeted funds are presented. The combining non-major fund statements are presented so you can see how that non-major fund total, how it breaks down with the individual funds that are presented there. And then finally, there's the statistical section, which begins on page 157 of the report and goes through the last page, page 182. So like I noted, 10 years of historical information for financial trends, revenue capacity, debt capacity, demographic, operating information. Lots of information is presented in the statistical section as well. That meets the requirement of the GFOA certificate program.
Well, thank you very much for the report, and now I'd like to open it up if you have questions for our staff or the auditor.
I guess I want to answer the questions that were brought by the public. I think it's important to respond since they came out this evening. They are probably more for Hitesh or Clayton. Let's see, one of the questions was about our, having a budget that's where we over budgeted by $105 million for expenses. We also ended up with a shortfall in the category as other revenue by about over 80 million. These are big numbers, and a concern. I also want to say that 18.3 million in overspending is a big number also, because as you've pointed out over and over again, and I appreciate it, each of the funds is an independent fund. So 18.3 million means, you don't look at the whole enormous 400 and whatever $20 million budget that we had, but 18.3 is a large number to be overspent. So we have three big numbers there, and I'd like to see less discrepancy, and I know GASB recently just passed, I think it's 103, a rule that'll be in effect in 26, where those disparities really have to be at the forefront of the budget, and so the public can see them, because it's important. You don't want to have such enormous disparities between what's budgeted and the actual budget. So
we are going to address one of them later in the agenda, but
that's okay.
Yeah.
All right.
The
then I guess
the over
those discrepancies. Okay, and then let's see. I had a question regarding the pension. Are we going to get?
Can we just do the first question that you had, just so we don't? The first question you had was. You had three questions just now.
I guess I wanted to get some thoughts on how we can. I'm sorry. Which
you mentioned three questions from the public. One was the over.
So, well, that was something, a point that was made that I think should be addressed by Mr. Mortel. There was a question about in the bills pay list saying that something was paid for with a revenue source that doesn't exist. The 2023 bonds, that something was paid for with the 2023 bond. I think we should at least respond to Ms. Rosinski. Again, I think it's confusing to cite a source that doesn't exist, a revenue source, as a means of paying for something. So I guess it would be good to give Ms. Rosinski a response to that.
Let's do one at a time. Okay. So what's the first question, just so we can...
Yeah, so I guess a response to listing in our bills pay list, paying for something from a source that doesn't exist, a revenue source.
Okay, I think we have discussed this item maybe at least a dozen times at the various levels, at the council meeting, finance, budget.
But it was agreed you wouldn't make that reference anymore, so. And she asked for it, so obviously I think it's not the public.
For tracking purpose in our system, and I think Lara has expressed and clarified this thing, how she tracks that, okay, 22 geo bonds or 23 geo bonds, yes. And the question has been raised, we never issued the bonds in 22, 23. But that is for our tracking, and particularly it is useful when we are going to have some reimbursement coming out towards those two bonds on the past. Even though we did not issue the bonds, for our tracking purpose, like Lara tracks the bond projects by 21 geo bonds, 22, 23. Now you say, yeah, we didn't never issue the bond for 20. Yes, we did not. But that helps us to make sure that, yeah, we are doing the right thing, because this is all kind of submitted for arbitrage purpose. This goes to the bond council, all those.
But there's no arbitrage, there's no bond issuance, so the arbitrage, I mean, you can't, we didn't issue a 2023 bond, so there's not an issue with those funds in arbitrage, because you would have taken from the general fund.
So can I maybe help here? I think that the money that was spent in 22 and 23 ultimately was reimbursed from a 24 bond.
Correct.
Right, and they're accounting for it is to say, look, this money qualified for 22 spending, that qualified for a bond. In fact, we had a resolution to allow that. So there was money in 22 that qualified for an eventual bond, money in 23 that qualified for an eventual bond.
I understand.
And then ultimately we issued
But we
it in
didn't pay
24.
for it from a
So the
bond.
nomenclature can be a little
So
bit
I
confusing.
think for transparency, we should not be referring to money, because we're not reimbursing bond. I just think that it's.
We
for
did
the public.
reimburse the CIP fund out
That
of
is
the
how
bond
we have
proceeds.
to say
Yeah.
the thing. If you look at the bond thing which we issued, it says, I think, that, yeah, this is the reimbursement for 22 projects, 23, and we have to show exactly what, even there are some restrictions that we can only reimburse up to serve. So for some 22 bonds, we have to reduce our reimbursement amount by bond, because the bond council says you cannot reimburse that because you are past that 24 or 30 months or whatever the limit was. So, but we could reimburse the entire for 23 based on whatever the reimbursement resolution was. And
Right, I just think I think there's got to be another way. I talked to our bond counsel, they said you don't refer to a 2023 bond if it wasn't issued. But anyway, but I know, but that this was asked from the public, so I think it's a practice that needs to be modified. And then a question about do we not get, I know by law we're supposed to get in the second Tuesday of May, there were some questions about the pensions that were supposed to be presented. It says here that the annual report by treasurer on the second Tuesday in May, annually the treasurer and all officials in the municipality who had custody of the pensions, we're supposed to get the council a full reporting of all money in and all money out, and I haven't seen that.
I mean, I don't know. I mean, I have never done that. But yes, I think I shared this with the pension funds. I don't remember, at least in my 15, 20 years here, at least last 6 years as a CFO, that council asked for the pension funds. One of the pension funds asked for it, and we provided that based on the legal counsel.
Okay. I mean, this is my first time as
can,
a
yeah, if you-
council member, but I just see that that's a law
You
here.
can share that document and put it in our Friday packet, or kind of officially present it to the council. yeah.
Okay. Okay. So it's not, I mean, I was just trying to get up to speed during these years of being a first-year council member, and I see the law says that we're supposed to get a full report of all money in, all money out on the second Tuesday of May. So that's not really very
Right, and
serious.
some of those things, I mean, Councilmember Kelly, those were the rules and regulations 50 years back when the city used to get the money and give it to the pension fund. That's no longer a practice. We don't touch the money. We don't get the money. It directly goes into the pension fund.
But you're the treasurer, right? So you're supposed to give that report.
Oh, yeah, absolutely. But my point is, I mean, some of those requirements, I think when I got a request for a pension board and I was looking at these things, and some of those things were irrelevant because the laws are from 50, 60 years back when we used to get the money and they say, yeah, you should provide the full accounting, how much money you give. But we don't get the tax levy money. That directly goes into the pension fund account. But I'm glad to provide.
That would be great. Thanks. I know I've been trying to get the breakdown on some of the funding. We've been back and forth and I haven't gotten it yet. So that would, I think, I would like to adhere to the law and get that full accounting of money, all money in, all money out, how it was paid. I think that would be, at least it looks like that's something that we have an obligation to do. Thank you. That's all for now. You wanted to go on to something else?
No, did you have a couple other questions? You were firing them. I just wanted to make sure we stopped and answered them.
I'm sure I have more. Let's see.
I know you had a question to me once about the insurance, which we already talked about, that we needed to reimburse those two funds. And you can see our reserve balances, our fund balances are where they should be now. So, Member Livingston, did you have a question?
Well, I think relative, these really big, we've talked about this too, the really big variances in budget, when you talk about the entirety of the budget, have to do with the large capital projects like the water intake project. And I think we have made a suggestion that we don't want to budget the totality of what's open anymore. Let's try to get a better view on
that's
what's
G1.
going to.
The next
Right.
That's on our
Okay,
agenda.
that's for good. But also, I think for a really good analysis, when I was going through the annual report here, maybe we'll get to this in a bit, but if you look on like page 112, it goes on for several pages. It gives a really great view of, for the general fund, here was the original budget, which I assume is September. Here's the final budget, which was what it was done in December. Here was the actual, here's the variance. This provides a really good view on what were the variances between the final budget and the actual budget by major fund. So there is, I think, enormous transparency here. And the discussion we've had before on the budget amendment, this doesn't flow into here at all. This is all just pure, what was the original budget? What was the final December budget? What was the actual? And you get a lot of granular detail in here on what was causing changes in other taxes, license and permits, all the major categories of revenue and expense. So it is a great schedule to really understand how things changed from budget to actual.
And next month, we are going to get the 6:30, so we can look at budget versus actual, so that we're going to be getting this on a more consistent basis. Councilman Kelly?
So, and what happens when we had this obviously too big budget, right? We had an enormous budget because we, this shortfall in other revenue by, 80 plus million, and then over budgeting and expenses by over 100 million. So we had a budget that was too big. So when we do that and we adjust our reserve, so our reserve is 16.6 in the general fund. I know we have reserve funds in like 8 different funds. Does that get adjusted, our reserves, according to the actual budget then? Or do we then, since we made an exaggerated budget, right? That was really not an accurate budget at all that we passed.
If I could say, it's the timing of the capital spending that is causing those major differences. It is not wildly off on individual line items of revenue. The capital project would have been funded by loans that were not issued. So that is what's causing this whole grossed up situation of, boy, the budget was 410 and or whatever it was, and ultimately we ended up spending 300. Almost all of that is the capital project.
So my question though is simple. I'm just asking if do we keep our reserve based on actual or based on the adopted?
Adopted budget.
It's always, our reserve will always be on the adopted. So if our adopted's off by 100 million, then our reserve is inflated.
So this is how, right? The reserves are for the future years. So when we concluded 23, so I would tie in that reserve with my general fund budget for 24, because those reserves can only be applied in the future, not in the past. So I would compare those two numbers. What is the general fund budget for 24 versus what is the fund balance of the general fund as of December 31st? And 16.6% of the 24 budget would be the amount I would consider.
Okay, any other questions? We have a couple things we're going to address in our meeting, especially with the CIP projects.
Particularly, if you have something for Martha, that would be great in terms of what Clayton presented, what do you call all those technological terms and the other thing, the fund balance, cash balance.
Okay, yes.
We're going to have to get you on a microphone, please. Thank you.
So there's a pension question. Could you pull up page 67 of it's this page of the audit? All right, yes. Please. I think you went right by it.
Right here,
Okay, so it says, the table below is summary of all and it shows IMRF. It's got a deficit of about 6.7 million. You see the police, you see the fire, those total up. But then could you go to this page, page 70? And then if you, get the narrative below it also, that shows a balance at December 31st, 2022. And the breakdown for the city and the library, you see it's 6.7 million. that number from 2022 you've used for 2023. Why is that?
So the IMRF pension plan is also reported on a calendar year basis. So the 2023 audited IMRF financial statements don't become available on a timely basis, and it could prevent the issuance of the city's report on a timely basis. So the city has chosen to present the most recent audited information of IMRF, which is 2022, which is available to us for testing purposes during the portion of our fieldwork part of the audit. So that's why we report, IMRF is reported 1 year behind. It's the most current audited information available. That would
Sure, it's in the footnotes, right?
2023 is not, because it is not.
But I mean, your dates are in the footnotes of which.
The dates are, yes, the dates are listed here.
Okay, Councilman Burns, you had a question?
First question, you mentioned there was a few, we should obviously review all of it, but there were a few pages that we should pay close attention to.
That's called MDNA, I think. Can you bring up the
Yeah, I'm trying to find the first one that you said.
Is this the one right here, right?
Starting on page 30.
PDF, page 30.
Oh, hold on, I'm scrolling to it now. I think I'm getting close. Okay, yeah. So the management's and discussion and analysis. Is there? I feel like you mentioned something else too. Is there another page that you said would be helpful? Maybe it was the footnotes.
I think it was a transmittal letter, maybe at the beginning. Was that it? I
The
think you said,
transmittal
but
letter right
those
at
are
the
both
beginning.
great documents to put the whole picture together.
Correct.
I agree.
So one thing, and I would just explain the major difference. Management discussion analysis, all numbers kind of, what happened compared to last year in all categories, all fun. Transmittal is more forward outlooking, how the economy looks, if you look at the last section. So yeah, the two documents differ in that, But yeah, both as a whole would give you a great sense.
Go ahead.
In the packet, it is, in the packet numbers, it's page 13 of 224 is where the transmittal letter starts. And then the MD&A is, again, these are the page numbers from the packet. The MD&A starts on page 31 of 224.
Okay.
But if people don't want to get lost in the numbers, but want to, I think there's been a lot of work done here to really try to make it understandable on what the number
it's good
means
stuff.
between those two.
That's helpful. Okay. And then the other thing is you mentioned that the role of your company is to come in and communicate to us, to this panel at least, that we can rely on the numbers that we've been provided by the city. Is that the only role you play? Do you also, is it also appropriate for you to comment on, to provide opinion on the city's financial health, to provide comment on things that we should monitor, or you stay out of that and you're just saying, look, the numbers are reliable, and then you leave it to this panel and staff to determine everything else?
So in order to remain independent auditors, we cannot provide any management context or consulting type services. So we do strictly focus on auditing the balances and providing our opinion on the annual comprehensive financial report.
Perfect.
So I just want to say Spear Financial, I think Anthony Maselli is the person that would do more what you're asking, I believe.
You're saying we've worked with him before? Is that what you're saying?
He's our financial.
Okay.
He's our bond. They
Not
work with
just
us on
bond,
bonds. I think another key constituent here are the rating agencies,
Okay.
right? They are huge users of this sort of information. And if there's a lot that we work on, there's a lot that we can improve. But the fact that the city is AA rated, that speaks for itself as well. That relative to
And thank you, Council, the member Livingston. Yeah, you brought it up. When we did the rating agency with S&P, they confirmed our, AA. We are only 2 notches down, AA plus and AAA from S&P. And Fitch, they do that compliance too, even though we did not use their service, but they look at it, and they kind of affirmed our AA plus rating with the stable outlook. So that's kind of speaks a volume for the city's finances.
And congratulations for no audit deficiencies, because I used to be an auditor and used to find a lot of them. So,
a couple more questions, if I can. It also, I think, in reading the MD&A, that it says, I'm just quick curious. It says our assets decreased by, I think it was like 49.5 million. What is that attributed to mainly? Is that, I would imagine it's not, we didn't sell any buildings, anything like that. Is it depreciation? Is
The
it,
net book value, yeah, the depreciation keeps on adding for one more year. So the net.
what are
book
the
value-
biggest contributors though? Is it depreciation and cash reserves?
Right,
Probably?
depreciation, yeah. And
Okay.
the cash too, yeah, total assets mean everything, which falls under the category of assets.
Okay. I think I had one more thing. And I guess I'm just curious from then staff's perspective, since their role is not to comment on our financial health, and is what are your takeaways from this audit?
I mean, I'm really happy. And again, I mean, yes, you might say, okay, as a staff and as a CFO, I might say, okay, we are doing good. But as I said, I mean, rating agencies, I mean, their reports out in the public, S&P, Fitch ratings, they've affirmed our rating with the stable outlook. Again, in AA plus in Moody's, next would be the AAA with the Fitch, the Moody's. So, I mean, that was a good thing too. So yeah, I mean, we are doing good. All the fund balances in a good health, general fund, enterprise funds like water, sewer, and other funds. And overall, yeah. And the one thing which I think, I mean, kind of off the record, but yeah, someone called me, one of my peers, and say, okay, I mean, it's a great thing that you guys have kept the pension, I mean, the tax levy flat for the last 3 years. You haven't issued the bonds for 2 years, still funded some of the CIP projects, And obviously, yes, some of those revenues coming at higher numbers, and adding to that is the investment income. I think we have received, $6.5 million in investment income for 23. So those factors have helped us, yeah. And we are trying our best, yeah.
Okay. Thank you.
Well, thank you, everyone. This was very informational.
Those are based on actuarial valuations. No, we do not perform actuarial services. So the pension funds hire.
It would be the Foster and
Actuary.
Foster report, so there must be some confusion as to which reports you're looking at versus what was incorporated into the audit. Yeah.
Well, maybe we can find the report we'll get you the report that they tied into it. Okay, we will, if we can get those numbers where you got them from, so we can reconcile it with the other numbers that Mr. Mortel's looking at. Okay, thank you.
So Councilmember Burns is here. We have a quorum. So this item was listed as a recommendation item for Finance and Budget to recommend to Council accepting and placing on file the audit report from 2023. So if we have a motion.
I want to say this was supposed to go to APW. It's supposed to go there as per the 2024 budget. It says it goes to APW immediately after it's issued, and staff did not put that on it needs to go to APW first.
Yeah, I mean, we corrected. It used to go to the APW when there was no finance budget committee. After the finance budget committee started,
that's fine, but
2
can we be
years
a little
back,
bit?
they decided that they should come to here, and it makes sense that this is
Of
the right
course.
forum to discuss the financials. So it comes to the finance and budget committee and then goes to the city council.
Okay, but then if we could just be a little bit more careful with our documents. I mean, it says in the 2024, it says it goes to the APW, and I was asked by several people, will this be on your agenda? And it was supposed to be. That's what we passed. So I would ask that it at least come to APW because that's what's stated in our 2024 budget and then to council.
I think incorrectly, because there's several committees that report directly to council, and all of that is on city website, and that's
Right, but it's stated in our
that's
budget.
where this should go. No, I understand. I think that was done in error.
I
And
agree, but
this
I'm
should
just
go
saying we
to-
got to be careful. There are a lot of errors.
No, I
There's too many
understand. I
errors.
understand. So I'll
Okay,
make
we have a motion. Do we have?
Yeah, I'll make a motion to recommend to City Council to accept and place on file the 2023 audit report.
I'll second that.
All right, taking vote. Councilmember Kelly.
Aye.
Committee Member Millen. Committee Member Livingston.
Aye.
Chair Rikus.
Aye.
Councilmember Burns.
Aye.
5-0 pass. Thank you.
Great. Now we're going to move on to D1, discussions regarding budgeting of CIP projects, which is something we have talked a lot about.
Yeah, so this item is from me, but I'm joined by Laura Biggs, and I think we'll probably share the item a little bit. So it's already been alluded to, sort of this, let me open the item. We talked about this at length whenever we did the budget amendment a couple months ago, noting that there was significant underspending, and most of it was, as Council Committee Member Livingston mentioned, on a $50 million project that just simply didn't move forward at the rate that staff initially thought it was. But it also relates to how we budget for CIP projects. And so we wanted to talk about that with this committee to help us get some direction on how you'd like us to budget for these types of large-scale capital projects moving forward. I'm going to focus on that piece. Laura's going to talk a little bit about staffing too and how that impacts how we budget capital projects. But our practice has been for a project like the $50 million water intake project to budget that entire project in the first fiscal year in which the work will be done, even though we know we're not going to do $50 million worth of work. And my understanding, being with the city now for just a couple years, is that that's been our practice, so that when the item comes to city council and you say, what's the budget for the project, our budget very clearly shows what the budget approved by the city council is for that project. So when they approve it, they say, yep, the budget's $50 million. We approve the $50 million contract. But at the end of the year, we may only spend $2 million, as was the case with the water intake project, and we underspend by $48 million. So there's a couple approaches. One is to continue doing this the way we do it and giving city council that full approved budget that they can use to approve capital projects, or only budget the amount we think we're going to spend. So if it's a multi-year capital project that, say, spans 3 years, we take that $50 million and we budget it accordingly in years 1, 2, and 3. Say the first year is $2 million, the next year is $8 million, and then year 3 is $40 million. But then the problem being when that $50 million contract comes to city council and they look at the budget and they say, well, the budget is just $2 million. Yes, that's the approved budget for year 1, but you're going to see this project again in year 2 and year 3. So we ask you to approve the full $50 million contract, knowing budget for this year is just $2 million. That second way is how I did it where I came from before. The city council there was okay with approving a long-term project that spanned multiple years, knowing that the future year budget was going to show up in a future year. But here, I know there's been sort of this practice of wanting to see the full budget in order to approve the project. And that's why we've done it that way. And that's why it's really been apparent in recent years, this underspending issue has kind of come to light, especially because we have some really big projects like the water intake project. We took the same approach with ARPA spending as well, where we budgeted the full amount, knowing that we're going to spend that full amount over the course of 3 years, but we showed that full amount in the budget in order to approve those individual projects. So wanted to share it with this committee, and Laura can talk more about how staffing also impacts this budgeting as well.
Yeah, and you and I discussed it, and I like the option too of only budgeting what we plan on spending, but then maybe having a supplemental schedule so we don't lose track that that $50 million was approved by city council, but it's going to be $10 million a year or $5 million over 10 years. I think that would be clearer and less adjustments, but I'm open to discussion on that.
Fully agree.
I can let Laura talk a little bit about the
This might be a
piece
short
too.
meeting because I also agree. I've spent a lot of time thinking about this, looking into it, and I'm curious to know what staff, I don't know if this impacts staff capacity because it'll take a bit more time, I would imagine, to monitor this and keep track of it all, but it sounds like the right thing to do.
No, it doesn't. It's really just a preference. It doesn't particularly matter which way we choose to do it. We just want to do it the way that meets the needs of the city council. But I should add that in the past 3 to 4 years, we've also had some really serious staffing challenges with significant vacancies that are hard to make up, and that impacts our ability to deliver the capital program. So right now I'm putting together the draft capital program for 2025. We have, in transportation, we have 4 civil engineers that design most of the in-house transportation program. 3 of those positions are vacant. So do I put together a program based on the fact that only 25% of my capacity is filled, or knowing that there's still 5 months left in the year, do I put together a program that reflects the actual number of positions we have? So I've been putting together the program based on the actual number of positions that we have and what I think we could do in the event that we had all the staff that we have. They're all posted, and we periodically do interviews, and often those don't work out, although we've been successful in hiring some people. and others then have chosen to leave. So it's just like the normal ebb and flow. But but that does result in we're approving capital programs that are greater than what we can actually deliver, just assuming that that capital program is set for the staffing level that's aspirational, that's budgeted.
So do we need a motion on this, or it's just a practice that you'll start doing going forward?
I don't think we need a motion on this. No, I just want to maybe seek just a little more feedback from the committee on, you mentioned the supplemental schedule. So we have a 5-year CIP that we put through as part of the budget. Presumably that will now start showing these projects, like a $50 million project spread out across multiple years. So when we bring the $50 million contract to committee, the budget's only $2 million in the first year. We would point to that 5-year CIP and say, you didn't approve year 2 budget, council, you didn't approve year 3 budget, but this is where we seek the authority to be able to approve the full contract.
Well, when they approve it, can they say it's 50 million, year 1 will be X, year 2 will be X, year 3, so that there's an approval year by year, so we don't have to?
That I don't know, but.
We have done this occasionally on some projects. It hasn't been consistent, but then what we do is we indicate that the budget for this year is this much, that as part of the 2020 X, the next year budget, City Council will need to approve X dollars. So we make that clear in the funding section of the memo. You can see that. Often, most of our capital projects have a complex system of funding sources when we're awarding the project, so we provide supplemental tables embedded within the memo that would make it clear.
Yeah, I mean, the only risk is could have turnover of council and another council approves something, so we want to make sure that what was previously approved will continue through future year budgets.
Yes, but that is somewhat on the staff to make sure that those numbers appear in the budget appropriately.
Councilman Burns?
Yeah, I think I'm following. I just want to make sure, because obviously the biggest concern, at least for me, is if projects don't get funded or delayed down the road. That's a huge concern. And so I think what you're saying is we would still approve the full amount, but we would just report it out as is being expended. And I would support that. I just want to make sure we don't have to go back and approve for the same project, have like 3 or 4 different approvals.
No.
Potentially across different councils, because that would be a nightmare, but okay.
No, the funding is approved as part of the adopted budget process, but the individual contracts do not come back to City Council each year. So
no, what he's saying is we approve 50 million, year 1, 5 million, the next year's 10 million. He doesn't want to have to go back to council and say, are you guys approving the 10 million of the project steps?
10 million,
So it's going to be a pre-approval for the next 5 or 8 years.
Okay.
Yes.
Yeah. Yeah.
That's what you were asking.
Exactly. Thank you.
Okay, thank you. Okay, now we're going to go to D2, update on our bond issuance. The question we had earlier.
So we sold our bonds last month. We had a good, kind of positive response from 9 different bidders. And this is a good one from Spear Financial. They have an online platform, so you can see who is bidding and how many times bid, and we had almost like 41 different bids from those 9 bidders. And yes, the rate is not the best, but considering the current environment, particularly we asked the Spear Financial, I think based on the Finance and Budget Committee directions, to run the numbers, and it was around 4.19, I think last year sometime, almost 6-8 months back, last October or so. So this is good number at 3.93, obviously, yeah, and again, that's why we always keep that call, 10-year call. So we can always refinance at the, because of the higher rate, generally we do the refinance of the old bonds too, which are due, and callable, but we did not include because we didn't see much savings there. So I said we would rather wait until the next year, and hopefully there are some rate cuts.
Okay, any questions on that?
And the bond closing on Thursday, so that's when we'll get
So it was a benefit for us to wait those 18 months, definitely.
No, I think it's, I think it's good. Everyone waited as long as they could. We did a big bond deal, you know,
Right.
in May. IGW did. I mean, it's just sort of at some point, you have to take the rate, even if it's not a rate you love, but.
And again, look at this. I mean, even today, right now, right? I mean, the rates are still as high as.
And also to get it behind us and not have to deal with any turbulence in the fall.
Right.
So I think you hit a window that a lot of people are taking advantage of, and at some point you have to issue.
And again, it is a 20-year bond, but we're still not kind of locked in for 20 years. There is a call feature after 10 years, so we can always call,
Well, and also it's a series of tranches, right? That's one thing about these bonds. It's
Yeah.
it's not all due at the end. It's due over 10 years, and then it's callable for the rest. So it does, it's not like we're paying 3.933 for 20 years. That's
Right.
not the case.
Okay, and in future meetings, we're going to have this amortization schedule so we can see when all the bonds are maturing and see what we're doing. Now that we have a quorum, we do need to approve the June 17th minutes. Do I have a motion?
I'll move the June 17th minutes.
Second?
Second.
Yeah, thank you. All right, and for roll call, Councilmember Kelly.
Aye.
Committee Member McMillan. Aye. Committee Member Livingston.
Aye.
Chair Rikus.
Aye.
Councilmember Burns.
Aye.
Thank you.
Okay, I think we're going to adjourn. Next month, we are going to start talking about Northwestern, and we're going to get some information on that. So if everyone wants to put their thinking caps on about that, and Mr. Mortel, we will get you those numbers so you can reconcile.
And also, it's just a reminder, August 20th, it's the third Tuesday of the month in August, not the second. We're meeting on August 20th, third. Yeah.
One thing, Sherry, I hope you could add, could we also look at how we're doing vis-a-vis our $500,000 policy? How much has already been requested that's over?
Yeah, we're going to
That'd
get
be great.
actual versus budget, but with the change of meeting, I had a family vacation plan, so I won't be here in August. So someone will have to chair. I'll figure that out.
We'll figure that out. Yeah. Thank you.